very much, and thank you everyone who's listening in today. I'm going to talk about the Jupiter Emerging and Frontier Income Trust, also known as JEFI, JEFI is the ticker. And this is an investment trust that we launched in 2017. And it's really very simple what we're looking to do. We're looking to maximize total return, but with an emphasis on income through investments across emerging and frontier markets. And we launched this trust believing that there is an opportunity to have something unique in the way in which we combine emerging and frontier market exposure, and also something unusual in that it offers quite a decent level of dividend today, but also has the potential for significant long-term capital growth as well. So let me talk a bit about how we approach this. As I say, we're seeking both capital growth and income. We're very much stock pickers, so what you'll see is a concentrated, high conviction portfolio built from the bottom up. Because it's built from the bottom up, because the portfolio represents our best ideas across the emerging and frontier world, it looks quite different to the benchmark. So we have a significantly higher small cap weighting. We also have a lower China weighting. China's a very heavy weight in the index, and we typically have a lower weighting in China. We're more geographically diversified than the index in that sense. And we have up to 25% in frontier markets, as the name of the trust suggests. The dividends that we pay are paid quarterly. If you look at the current trailing yield, it's 4.1%. If you take the most recent dividends that we paid, the most recent quarterly dividend of 1.2, that suggests an annualized yield of about 4.7. And I think that is more representative of how things are looking now that we're seeing some normalization post-COVID. That trailing yield, albeit still quite a respectable yield of 4.1%, that reflects a period when COVID was having a significant impact on emerging and frontier markets. So why is it that we believe emerging and frontier markets are a sensible place for investors to have some of their money allocated? Well, one of the reasons is demographics, and really it's a very simple argument that we have demographic challenges in developed markets. In the UK, where the median age is 40, the workforce and the consumer base is at risk of stagnating and ultimately shrinking. It's also potentially an issue in China as well, as China's population ages. But if you look at most emerging and frontier markets, the demographic picture is very different. You've got a demographic tailwind with very young populations, so a median age of less than 30 in India and as low as 20 in somewhere like Kenya. So that really can be a tailwind for corporate earnings from a long-term perspective in some of those markets. Also, debt is a very similar difference between developed and emerging and frontier markets. So if you look at household debt to GDP in somewhere like the UK, it's around 90%. Go to the other side of that chart at the bottom right of this screen and look at somewhere like Pakistan, and household debt to GDP is only 5%. So you have a very long runway for growth in some of these less developed economies as credit penetration rises over time. And also governance. I think it's important to touch a bit on governance. I get a lot of questions about whether corporate governance is a challenge in emerging and frontier markets. And I think that in many ways, the perception of corporate governance in these regions is somewhat outdated, because there has been a big improvement in corporate governance across the asset class, certainly during my career over the last 22 years or so. And I think the single best evidence for that is that there's a higher proportion of emerging market companies now paying dividends than is the case in developed markets. And the payment of dividends to shareholders really is the best indication we can have that management is aligned with minority shareholders and is willing to return cash when it's appropriate to do so. And just to illustrate how important dividends have become to the total return story in emerging markets, we've got this chart here which illustrates since 2000 the total return of different asset classes. And emerging market equities are one of the better returning asset classes globally over that period since 2000. And perhaps surprisingly, over half of the total return that an investor has got from emerging markets is actually from the dividends, as opposed to the capital growth. So both have been significant, but dividends have been a larger part of the total return story. Now, I want to say a bit about how we think about different types of dividend-paying stocks in the portfolio, in the Jupiter Emerging and Frontier Income Trust portfolio. Importantly, we do allow ourselves to hold some companies that pay low or no dividends today. So that's that future income potential bucket, which you can see labelled at the top. So these are companies that perhaps aren't paying dividends today because they've got opportunities to reinvest at high rates of return on capital, but businesses where we're confident that in time they'll become significant dividend payers. The two larger buckets we have are high income visibility. So these are companies typically yielding over 5%, where there's a more predictable income stream, and companies where there's still growth, albeit probably lower growth than you see in the income growth bucket on the right-hand side. These are companies yielding 2 to 5% typically, makes up about 50% of the portfolio. And I think this is something that's quite different about the opportunities in emerging and frontier markets. In developed markets, that kind of yield may suggest that the company is low growth. That doesn't have to be the case for a lot of the opportunities we see in emerging and frontier markets. Now, there's a lot of talk about ESG these days, and I just want to talk very briefly about stewardship. We have always had stewardship at the heart of what we do, and what we think of as being important are these 3 points. So alignment, we want to see management teams that are aligned with minority shareholders like all of us. We want to see good capital management, and capital management and alignment, really those are related in that dividends and share buybacks are often a big part of the discussion around alignment and capital management. And then when it comes to environmental and social risk, we want to see mitigation of those risks. We want to see good disclosure and good reporting. We're certainly not in the habit of excluding a sector like mining, for example, just because it's high risk. It's actually an essential sector to the economy. But what we do want to see is management teams being responsible in the way in which they act. And so we seek to add value through engaging with companies rather than having blanket exclusions on any particular sector. Just to touch on performance, and I should say that 2020 was a difficult year because COVID had quite a significant impact on some of the smaller emerging markets and frontier markets. What we have seen so far year to date is a strong recovery as the market has started to look through the impacts of COVID. And I think not just the market looking through the impacts of COVID, but we've seen a lot of our companies demonstrate, excuse me. We've seen a lot of our companies demonstrate that actually they've been very resilient through COVID as well. So corporate earnings typically surprising the market positively. So the total return since the trust launched with the dividends reinvested is in the mid-30s, similar to the index return. And that's despite the fact that frontier markets have actually lagged broader emerging markets over that period. What we've seen recently, though, is frontier markets starting to become a tailwind to performance as frontier markets have started to perform in 2021. We've heard quite a bit today about valuations. I think there are valid concerns that valuations in some parts of the world are certainly looking high relative to history. And I think an important point for me to stress is that the valuation of the portfolio in JEFI is actually quite attractive versus the emerging market index in our view. So you've got an average PE of 11.6 times versus 15 times for the index. Higher dividend yield, of course, and also higher profitability of the average company in the portfolio. Now, I said at the very start that we're bottom up, that we're stock pickers, and we are stock pickers rather than thematic investors. But there are certainly some very clear structural changes or themes that come out of that bottom up stock picking. I'm going to touch on a few stock examples that fall within financial inclusion, technology enablers, and rising discretionary spending. 3 of the structural changes that the trust offers significant exposure to. So financial inclusion is, it's a concept that is widely talked about, and it's commonly seen as bringing the previously unbanked into the financial sector. But financial inclusion is about a lot more than that. It's about the proliferation of financial products that weren't previously available to the population in a lot of the markets where we invest. And that proliferation of financial products, that creates really real opportunities for incumbent banks. So while in developed markets there's a lot of excitement around pure fintechs, I think what is more exciting in emerging and frontier markets is where you've got strong banking franchises like Kenya Commercial Bank, which was a leader in mobile money lending in Kenya over the last decade or so, or in Bank of Georgia, where Bank of Georgia's got a 49% share of all digital payments in the country. These banks can really leverage their early mover advantage to sell new products to their customers. In the interest of time, I've gone to talk about the next structural change or theme that we're exposed to, and that is technology enablers. So technology enablers are companies that may not be household names, but they are critical to some of the big technological changes taking place globally today. And MediaTek, Chroma, Hynix, they very much fit that definition. So MediaTek is the world's largest designer and producer of chips for mobile phones, for Android handsets, but they also custom design the chips for the Amazon Echo. So if you've got an Amazon Echo in your home, that's powered by a MediaTek chip. Chroma ATE is a Taiwanese small cap that we've been invested in for a long time, and about 30% of their revenue in some way or another is related to the testing of electric vehicle batteries. So, given the safety concerns around electric vehicles, clearly battery testing is a critical part of the process, and Chroma is key to enabling that testing. Just to talk about the third and last of those structural changes that I wanted to highlight. Companies benefiting from rising discretionary spending. These may not all be obvious, actually. So IDH is not a consumer company, it's actually a medical diagnostics company. But what we observe in a lot of emerging and frontier markets is that medical spending is much more discretionary than it is in developed markets. So we might take it for granted that if you want to have a test, it's provided either under health insurance or by a national health service. But these tend to be out-of-pocket expenses in somewhere like Egypt, which is the home market for IDH, or in some of the other markets that they operate across the Middle East and North Africa. And we are seeing a significant rise in people's spend on testing. Testing per capita is still much lower in Egypt than it is in more developed markets, but that means that we have a long runway for growth for a company like IDH that has got a trusted brand and significant capability in that area. So obviously talked about a few stock examples already. This map is really to illustrate how diversified the trust exposure is across both countries and sectors. And without going into detail on these names, I just want to highlight that we've got here a stock exchange, or the stock exchange in Mexico, salmon farming in Chile, port operations in Brazil, medical diagnostics in Egypt, banking in Georgia and Kenya, one of the world's leading retail malls in Dubai, Vinamilk, which is a Nestle type business, a homegrown dairy products company in Vietnam, and NetEase, which is a leading publisher of mobile games in China. Things like the Harry Potter franchise and Minecraft are published by NetEase. So it really is quite a diverse mix of companies that we are invested in, and I think that diverse exposure is important in terms of managing risk in the portfolio. So how does the portfolio look relative to the index? We already touched on the fact that valuations are certainly lower for the portfolio than for the index. I think a couple of other things to highlight are that the small cap exposure is much higher. So 53% exposure to small caps in JEFI, and that compares to less than 1% exposure in the index. So small caps, where some of the most compelling opportunities are from our perspective, they're really underrepresented in the benchmark, but we believe well represented in this investment trust. So just to wrap up and make sure that we've got time for questions, I want to highlight that I do believe that we are well positioned to benefit from some of these structural changes that are playing out in emerging and frontier markets. What that means is that there is the potential for good long-term dividend growth from what is already quite a respectable level of yield today at around about 4.1% on a trailing basis. I think this third point about valuations being low relative to the index and also to developed markets, I think this is an important point. We've heard from other speakers that there has been a lot of emphasis on growth, but as a consequence, some of the valuation opportunities in the market really should be attracting more attention from investors. And I think that in a world where lots of asset classes do look quite expensive, diversifying an investor's exposure with an allocation to somewhere where valuations are much more reasonable, I think that makes a lot of sense. So the last point is that fundamentals for underlying companies, we believe, should be supportive of earnings and dividend growth, partly because we are now coming out the other side of what has been a tough COVID experience for emerging and frontier markets, but also because of some of those longer term factors that I talked about earlier on in the presentation, the more supportive demographics, the lower level of debt and the long runway for growth that presents for companies. I'll leave it there. I know we're short of time, and see what questions we've got.
Okay, first up, you mentioned you're underweight China relative to the index. Where are you overweight then?
We've got a slide. Let me just go to the slide showing country allocations. So you can see here that a fairly consistent overweight for us has been Taiwan. Up until recently, actually, Taiwan was the largest single country exposure. If you look at Hong Kong and China combined, that's now slightly overtaken Taiwan because we have found that some stock opportunities have been thrown up by the recent weakness in China. But Taiwan is a market where we find some very strong multinational businesses that really just happen to be based in Taiwan, and businesses that fit in that income growth bucket. So a lot of Taiwanese businesses are yielding quite a decent level today, but they're also delivering strong earnings growth and should continue to deliver strong earnings growth well into the future. I think Mexico is also worth highlighting as a market where you've got some very well-run businesses in Mexico trading well below long-term average valuation levels. And Mexico is actually in a great place in terms of its competitiveness relative to China, and obviously its proximity to the US as an outsourcing base.
And another question, I think, on the same theme, could you define, for those who are not familiar, what's meant by frontier? Is there a definition, frontier as opposed to emerging?
Yes, a very good question. I was going to cover that earlier, but in the interest of time, I was giving the short version. And yeah, frontier markets really are those markets that are less developed, either from an economic perspective or from a financial markets perspective, relative to their larger emerging market peers. So large emerging market economies, it would be China, Russia, Brazil. Typical frontier economies would be places like Kenya, Georgia, Vietnam. Very often frontier markets, because they're less developed in certain respects, they also have greater growth potential.
Now, the question about governance, do you go and meet any of these companies?
We do. So I would normally say that one of us from the team is on the ground pretty much every month in a frontier or emerging market, meeting companies. Obviously, that's been impossible in recent history, but we're already talking about when we'll be able to get out and start visiting companies again, because I think it is important to actually get on the ground and get a proper feel for a lot of the companies and their operations.
And do you invest in any private companies? Are you allowed to do that with the trust, or is it all publicly listed?
So they are all publicly listed. So we have that scope. But if you look at the opportunities that are available in the listed universe, given how compelling we think the valuation opportunity is in a number of smaller companies, it doesn't make sense for us to really venture beyond that space. And the trust structure does give us the ability, as some other speakers have highlighted, to buy some names that would be not really in scope for an open-ended fund. So we are taking advantage of the trust structure, but we're not buying unlisted.
And I had a similar question earlier on as well about the range. You showed the weighting to smaller companies and being very high. For you, what is a smaller company?
So for us, smaller companies are those less than $2 billion in market cap. Mid cap is 2 to 10 billion, and large cap is above $10 billion. So it's a slightly, I think it's quite a standard definition. Some people would define small cap as below $1 billion rather than 2 billion, but for us it's below 2 billion.
And a question here, could you talk to the portfolio turnover, please?
Yes, so we expect a typical holding period for a stock to be about 3 years, although there are certainly a number of names that we've owned since the trust launched back in 2017. So we will hold some names much longer than that. But that leads to a level of turnover somewhere in the high 20s, high 20s to 30%.
And I guess a nice follow-up on this is, when do you sell a company?
So the best way to answer that is probably just to touch on the process a bit, and to go to this slide here, which shows how we think about idea generation. The way in which we put together an investment case, which is identifying a positive change in a business. Secondly, analysing what's already priced in, and thirdly, looking for catalysts for the market to re-rate that business or come around to our view of that business. That framework not only gives us a way of thinking about when to buy a stock, but also when to sell a stock. So if an investment case starts to fall down on one of those 3 pillars, if the change isn't materializing, if the valuation, in our view, reflects the change, or if catalysts have fully played out, then that's where the sell discipline comes from.
Lovely. Well, in that case, Ross, I think we're about done. And so thank you very much for joining us tonight. Thank you for the presentation.
Thank you very much for having me on. Thank you.